Hi, everybody. Wagner Nolasco here again. Today, I have a very special friend and guest here today to talk about cost segregation, bonus depreciation, make sure he answers every question you guys have, and to teach us a lot about cost segregation. Erik Oliver, you are one of the most amazing guys in the industry in the US. You represent Cost Segregation Authority. So welcome, Erik Oliver. Thank you very much for being here, my friend.
Oh, no problem. Thank you for having me, Wagner. I appreciate it.
Absolutely, my friend. Thank you so much. So, without further ado, people are waiting to hear about this. Can you explain to us, Erik, what cost segregation is? What does that mean for real estate?
Sure. So cost segregation really is just accelerated depreciation. And so one of the great benefits of getting into real estate is that you get to depreciate your assets, which gives you a write-off against your income over time. And so typically, residential rentals are depreciated over 27.5 years, and your commercial properties are depreciated over 39 years. And instead of taking 1/27th of a deduction every year, a standard straight line deduction, what if we can accelerate those deductions and put them in the early years? And there's a number of reasons why you do that. You free up cash flow, time value of money. We've got something called inflation that's going on. That's kind of a hot topic right now. And so being able to accelerate the depreciation and take your deduction now is a huge benefit for real estate investors.
Absolutely. So pretty much cost seg, if we wanted to talk on layman terms, I'm not a very sophisticated guy, as you know. I have to try to make it simple.
Sure.
So for example, if we have a house that it's worth $227,000, right? And we can depreciate, $227,500, just to be precise. And if we can depreciate that in 27.5 years, that's a $10,000 a year deduction. How good is this? On this house, if I can write it off $10,000 per year, how good is it? How quickly can I depreciate that house? How does that work?
Sure. So that's a great example. You've got a $275,000 home. You get to depreciate that over 27.5 years. That gives you a $10,000 write-off every year. So what does that really mean? So that means, let's say I make $100,000 a year and I'm in a 25% tax bracket. That means that if I make $100,000 a year, I got to pay $25,000 in taxes. But if I have a $10,000 write-off from my real estate, instead of paying $25,000 in taxes, now I only have to pay 30% of $90,000 because I have a $10,000 write-off. So I'm taking this $10,000 off my taxable income, and it's creating a tax savings. So instead of paying $25,000, I'm now paying, well, in that example, I can't do the math in my head. I'm paying 25% of 90,000, which is what, 18 and some change, right? And so you're saving money by having these deductions. But again, Wagner, what if I can take a much larger number up front? Instead of just taking 10,000, what if I could take, in that same example, what if I had a $60,000 write-off by doing cost seg study? So instead of being taxed on 100,000, now I'm only taxed on 40,000.
Wow, that's huge, right?
And so that's really what cost segregation is. And I'll just take a step back if you don't mind, Wagner. The way that happens is when you buy that asset, you're not just buying the land and the walls, you're also buying a little bit of carpet. You're buying some appliances. You're buying a parking lot, or maybe not a parking lot, but at least a driveway. You're buying some sidewalks, curbs, gutters, asphalt. There's all these different components when you buy a residential rental that the IRS says should be depreciated over a much shorter period. And so that's really how cost segregation is done, is we come in and we segregate that $275,000 purchase into those different buckets. And carpet is a 5-year asset. So you get to depreciate your carpet over 5 years. So that's how we front load that depreciation.
Oh, that's amazing. So pretty much, if I understand correctly, that's going to be taken out of your total income. If I made $100,000, that it's taxable, I'm going to take my cost seg study and I'm going to deduct from that. So if I can actually claim $60,000 out of my single family home of the first year and I made $100,000, now my tax basis is now $40,000. I deducted $60,000 from $100,000, which left me $40,000. Is that correct?
Correct. Yep. So you're going to be taxed on $40,000 versus that $100,000. That's correct.
That's amazing. That's amazing. So cost segregation, if I understand correctly, every item on the house is a different lifespan. For example, roof, electric, drywall, carpet, right? And that's pretty much what we do. We accelerate that. So in your experience, Eric, for example, a house that is a brand new house that we just purchased today, 2021, 2022 construction code, and we're going to bonus depreciate. What's the percentage that you have seen, and I'm not going to hold this to it, on the first year? What's the percentage of the purchase price you can actually depreciate on the first year?
Yeah, so you mentioned a word in there that we haven't touched on, but that's bonus depreciation.
Ooh,
and bonus
that was my next question.
Yes, bonus depreciation is a very powerful tool. So let me answer your question first. If you were to, typically you can segregate about 30%. Now, you don't get to depreciate land value. So when you buy a house for, let's say you buy a house for 350, you have to back out, $60,000-$70,000 for the land.
Got it.
That leaves you with your depreciable basis. And then we usually segregate about 30% of that depreciable basis in the first year. So kind of some quick back of the napkin math, purchase price minus land times 30%. That's usually what you can write off in your first year with bonus depreciation.
That's great. So for example, that's big. That's really big.
Yeah. So you take a $200,000 home, that's $60,000 in the first year.
Right. Thank you so much for answering that. You mentioned a magical word that I know it's very new into the market. This will actually happen. We're not going to talk politics today, right? Nothing to do with politics. But as per my understanding, President Donald Trump brought bonus depreciation into play, and now we can actually combine that with cost seg. So can you tell us a little bit about what bonus depreciation is for real estate?
Sure. So bonus depreciation is a tool that the government kind of utilizes to stimulate the economy if and when it needs to be stimulated. And so they essentially, what they do is they allow you to depreciate even faster certain assets. So I'm just going to use a bulldozer example because I think it's easy to visualize, but let's say you buy a bulldozer. Normally a bulldozer gets depreciated over, let's say, 20 years. If you buy that bulldozer when you have 50% bonus depreciation, you get to take 50% of that cost and depreciate it in the first year, and the other 50% gets depreciated over the next 19 years. And so bonus depreciation, again, so the reason the government puts bonus depreciation out there is so that people will go out and buy new machinery, new equipment, and it helps stimulate the economy. One of the rules with bonus depreciation is bonus only applies to assets that have a useful life of 20 years or less. So let me ask you, what is the useful life of real estate? It's 27 and a half or 39, right? So people think, well, how does bonus fit into real estate? Well, that's where a cost segregation study is so powerful, is now when you've had a cost segregation study done on your 27 and a half year asset, you've taken that 27 and a half year asset and you've broken it up into these different buckets, a 5-year bucket, a 7-year bucket, and a 15-year bucket. Now that 5, 7, and 15 year, all those assets that we can put into those buckets are eligible for bonus. And right now, under the current tax law, like you mentioned, part of the Tax Cuts and Jobs Act of 2017-18 was the implementation of 100% bonus depreciation.
Yep.
So now you take that purchase price, let's just, in this example, say a $300,000 purchase price. We're going to segregate 30%, so let's just call it 100,000 into those short asset life buckets. You get to take that full 100,000 of deduction all in the current year. Normally, that $100,000 would have to be depreciated over either 5, 7, or 15 years. So let's say that it was all 5-year assets. You would have to take roughly $20,000 every year for 5 years. But it's eligible for 100% bonus, Wagner, which is just, it's really put depreciation on steroids, to say the least.
That's huge. I mean, that's every investor's dream, at least mine. That's powerful. I have a question for you. I have a lot of questions, but bonus depreciation, cost segregation, this is the topic of the moment because, it's not how much you make, it's how much you keep at the end of the day. Right. So I am a real estate professional. How does that change my scenario as a real estate professional? Sure. Can I take more depreciation? Can I actually offset that towards capital gains? How does it work?
Yeah, no, that's a great question. So you kind of have the golden ticket. If you can claim yourself as a real estate professional for tax purposes, it really kind of changes the rules on how this depreciation can apply. And so to be a real estate professional, you're basically, when you file your taxes, down on the line, there's a line there that says, what is your occupation? You know, you put a salesman, you put a doctor. In your case, you put a real estate professional. When you tell the IRS that you do real estate for a living, like I said, it changes the rules. So in order to qualify as a real estate professional, there's a couple tests that you need to pass. You need to spend 750 hours a year doing real estate, and you need to spend 51% of your working time doing real estate. So if you're a teacher for 40 hours a week, you would have to do 41 hours a week doing real estate, which the IRS is going to say that isn't possible. You know, you have a full-time W-2 job. There's no way you're doing 81 hours a week in terms of work. So, but by qualifying as a real estate professional, the deductions that we create, or depreciation for that matter, typically gets treated as a passive deduction. And so passive deductions can only be used to offset passive income. So I'm going to say that I'm a teacher. I'm a teacher full-time. That's what I do for a living. I make $100,000 a year as a teacher. If I have real estate on the side and I create these deductions, these depreciation deductions, those deductions cannot be used to offset my W-2 teacher income. They can only be used to offset my rental income. So whatever money I have coming in through my rental properties, I can offset that with those deductions, but not necessarily my W-2 income. Now you, because you're a real estate professional, that's not the case. You can use these deductions to not only offset your rental income, but also any other income you or your spouse may have if you guys file a joint tax return. And so that's really the power of that real estate professional. Quite often we work with a lot of professionals like doctors, and doctors have, you know, really high W-2 income. And because they have high W-2 income, fortunately, their spouse oftentimes gets to stay home and they don't have to work. Well, if they can get the spouse to qualify as the real estate professional, they go buy some real estate, do cost segregation. Now, all of a sudden, all those deductions offset the real estate income, but they can also offset that doctor income, which is super powerful.
You stole my words out of my mouth. And actually, I can relate to this in person because my wife is a physician. So she owns her clinic. I am a real estate professional, and we can really offset a lot of her W-2 income. Well, she's a sole practitioner on her clinic, so she does have a W-2. And anyways, but it is powerful. So this message is for you, real estate investor, or if you're just starting in real estate and you have one of your spouse that has time available, as long as they have a real estate license, they dedicate their time to real estate. I mean, ask your CPA what the guidelines are. We're not CPAs here trying to give you advice, but this is powerful. You can offset direct income from W-2 instead of only actually working on the rental income or passive income that it is derived from those properties. Now, Erik, I have a question for you. What happens if I decide to sell my property in 5 or 10 years? How does that actually play a role into my cost segregation bonus depreciation?
Sure. No, that's a great question, Wagner. So that's a question we get quite often, because when you sell an asset, there's two types of tax you pay upon sale. You pay a recapture tax on the depreciation you've taken, and you pay capital gains tax. And so oftentimes people will say, well, Erik, why do I want to front load all this depreciation? Because don't I just have to pay it back when I sell the asset? And the answer is you pay some of it back at a lower rate. And I'll kind of explain that. The whole idea behind cost segregation is you want to take your deduction at your high ordinary income rate of, let's say, 37%. And when I pay it back in 5 years, when I sell my asset, I'm paying it back at a capital gains rate of 20%, or at the highest 25% recapture rate, and saving the spread. Now, you're not even paying it all back. Let's say you did pay it all back. You're still saving 12%, and it's basically an interest-free loan from the government, right? But you're not paying it all back, and I'll kind of back into how that works, Wagner. But if you own your asset for 5 years, and I'm going to use carpet as an example. Carpet is a 5-year asset. You buy your building in 2020, you sell it in 2025. What is the value of that carpet when you sell it? It's worth zero. It's a 5-year asset. You've owned it for 5 years. It's worth zero. If you don't do cost segregation and you have a building in you buy it in 2020, sell it in 2025, and let's just say it doubled. The market's great. You bought it for $500,000, you sold it for $1 million. When you go to settle up with the IRS, if you don't do a cost segregation study, you're telling the IRS that everything doubled in value, right? You bought it all for 5, you sold it all for $1 million. So your land is worth double, your walls are worth double, and so's that dirty old carpet. It's now worth double. Well, that's not the case. Carpet doesn't go up in value. Carpet goes down in value. And so by segregating those components out, when you go to settle up with the IRS, you get to allocate your sales price to the right bucket. And hence you get to reduce the amount of capital gains you pay when you sell that asset. And so to summarize, Wagner, because I know I kind of got a little bit in the weeds there, but to summarize, you take your deduction at the highest rate, pay back a portion at a lower rate at a future date, and save the spread.
That's powerful. And yes, it's better to pay capital gains than to be taxed at the highest tax bracket as you wish on a W-2 job or any any income that is not produced that could be actually bonus appreciated or with the cost segregation studies and everything like that. So you don't want to pay 37.5, you don't want to pay 40% taxes if you can actually delay and pay 25 at a maximum, but on a lower amount because you're already depreciated. Most of it, it's great. I have a question for you. This is actually my personal properties. And as you guys know, I eat a lot from my own cooking, and Erik is working right now on 5 properties for me on Cost Seg, but I have an address, 51 Low Coast. This is in Ocala, Florida. I paid $169,000 for this house. I waited almost 9 months to be ready because of construction delays and everything else. As you know, if anybody tells you they're not having a material supply chain issue, they're lying to you. I mean, there's nobody in the US right now that is not going through a lot of hurdles, but we're delivering property. So I bought this property for $169,000. Today, the property is worth at $255,000. What is my cost seg basis? Is it the contract and purchase price at that time?
It is. Yep. You only get to depreciate what you paid for it. And so your depreciable basis would be what you paid for it, not necessarily what it's worth today. That's correct.
Okay. If I did a refi today for $255,000?
Nope.
I tried.
That's a good try. That's a good try, Wagner. I see where you're going here. No, if you refi, the IRS looks at that as a arm's length transaction. So you're, obviously we would all just, sell it to our spouse for the higher current market value and be able to do that. So,
hey, I have to ask. A lot of people that don't have the courage, right? So I have to ask.
That's right. No, it's what you paid for it. And so, that's all the IRS allows you to depreciate. So in your case, it'd be the 169.
Fantastic. Erik, what did I forget to ask? What is a question that you usually have very frequently that will help investors about cost seg? But, the floor is yours. Just educate us.
Yeah, sure. So no, you've asked great questions. I appreciate it, Wagner. I think the one thing that we should probably cover, a question we get asked quite often is, I've owned these properties since 2014. I wasn't aware of cost segregation. Is it too late to go back and do cost segregation on these properties that I've owned in prior years? And the answer is no. The IRS actually allows that to happen without having to amend any prior year's tax return, which is great. So let's say you bought a property in 2014. You've been taking your standard straight line depreciation over the last 7 years. And now all of a sudden you want to accelerate those deductions. You can have a cost seg study done today. We would do our cost seg study. We would basically say, okay, you were eligible for this amount of depreciation. You've only taken this amount, and you get a big, what we call catch-up number that you get to drop on your current tax return. There's a form that we fill out that you would have to submit. It's just called a change in accounting method, but basically it just tells the IRS, I've been taking my straight line depreciation. I now want to accelerate it. And here's the difference in those numbers. And you get to take that on your current tax return. So we're actually right now, Wagner, believe it or not, we're still working on our 2021 clients. So, as most of you know, it's tax season. And so we're getting taxes done for the 2021 tax year. But if you go to your CPA and your CPA says, okay, Wagner, I've done your taxes. You got to pay $60,000 in taxes this year. Say, hold up, wait a minute. I've got all these properties. Can I do cost segregation and offset some of that tax liability? So you essentially have until October 15th, if you extend, to do cost segregation for your 2021 tax year.
That's huge. I appreciate that. So October 15th is the day. If you're
Yeah.
actually looking to actually still change your 2021 tax returns, quite amazing, right? So you can pretty much fly back, go back in time, just like a
Yes.
time capsule and then make that happen. That's great.
Yeah.
Great answer, great explanation. I don't have any more questions unless you do more explaining. It's amazing what you can do. What's the cost of a cost seg on a per house basis, or is that on a case by case, Eric? Just to give
Sure.
our investors an idea.
Yeah, no, that's a great question. So cost segregation really is, the IRS doesn't allow us to charge based on your tax savings. I wish it did, because the tax savings is huge. We could say, hey, we'll get 10% of that, you get 90%, we'll all be happy.
Right.
But we price everything based on size and scope of each project. So usually on single family rentals, they start out at about $2,200 for the study, but we want to see you save 7 to 10x that in terms of taxes. And so what we'll do, and most cost segregation companies out there will do, is do what we call a free benefit analysis, where you share with us a little bit of information and we look at it. We come back and say, okay, based on this information, we're going to save you X amount of tax dollars and our fee is X amount. And then you can decide from there with your help of your CPA if it makes sense. Cost segregation, it's not a matter of if it makes sense, it's just a matter of when. You want to use it to manage tax brackets. So that's the great thing about cost segregation, is you can kind of keep it in your back pocket and say, okay, I had a really high income year, I'm in that highest tax bracket this year, I really need some deductions. Oh, wait, I've got these other properties. Let's do cost segregation on those and let's get that tax bill down. So yeah, you're looking probably on single family rentals, 22 to, we do some real big Airbnb type things where they're, 10,000 square feet, where they may be more than that, but usually between 2,000 and 3,000 for your single family rentals.
So that's an entry level cost seg for you on a single family home investment property. We're actually signing a partnership with Erik. So if you buy a property from us and you want a cost seg done, we're going to take all the hard work on our hands. Meanwhile, the properties are under construction to prepare your address for Erik. As soon as you have your property completed, he can conduct your cost seg. So if that's something you desire, just in full transparency, we don't make any fees off of Erik's company. This is actually a value add service to you as an investor. If you work with us, we'll help you throughout the process. As you know, we actually want you to thrive and buy more properties and generate financial freedom. So anything that Wagner and his team and me, of course, I'm Wagner. I don't know why I said my name. Weird, right? Can do to help you guys. That's why we're here. This is the provider that I'm using for my personal houses. That's why I recommend. We have a long track history working with the same people in this industry, which are very high network, a lot of actually properties and huge networks. So this speaks very loud for me and very highly for me. So let's see if we have any questions, Erik. Let's open up for questions. And if you guys have any questions, now is the time to ask Mr. Erik from Cost Segregation Authority. Let's see if we have any questions here for us. And yeah, I don't think we have any questions today. Our attendees are very, no questions today. I think you were so good. I have never had a webinar that actually we didn't have any questions. So Erik, I really appreciate you being here today. Thank you so much for working through the technical difficulties to be here with us today. If you're attending live this presentation, I really appreciate your patience on being with us. We had some technical difficulties. So this video is going to be available to you offline as well on YouTube. We can send you a link as long as you send us an email to marketing@b2rdirect.com. Before I go, Erik, do you want to leave your phone number, your email address to some of our attendees that actually, how can they contact you? We'll be more than glad to actually share Erik's information as well. But please, Erik, feel free to leave your phone number, your name, your email address if you wish.
Yeah, so it's just Erik Oliver. I work for Cost Segregation Authority. Our website is just www.costsegauthority.com. And then I can be reached on my cell phone at 602-568-0032 or via email at Erik, ERIK, at Cost Seg Authority. That's COSTSEG authority.com.
Fantastic, Eric. Thank you very much. And once again, if you want us to actually get an email and introduce you to Eric and his team, we'll be more than glad. Eric, thank you very much, my friend, for being available today on this Thursday. I hope you have an amazing day, and I really appreciate the personal help on my personal houses as well. So thanks again, Eric. And if you need anything, we're here for you. One second.
Thank you, Wagner.
We have question.
All right.
Yeah, we do have a question. So let me see here. Actually, this is a great question. How can I reduce the taxable basis in a situation below? 2010, buy a second home for $70,000. In 2021, sell it for a net proceed of $360,000. Capital gains are $290,000. Not sure if you're going to be able to answer this live, but maybe.
No, yeah, that's a great question. So one way that you can do that would be to, and I don't know your investment strategy or if you plan on buying a new property, but if you were to take those proceeds, there's two things that you can do. One pertains to cost segregation, where you could go out and buy a new property. Let's say you take that money and put it down on a $800,000 vacation rental or multifamily, or you buy a couple single family rentals. You could then do cost segregation on those properties that would offset that capital gain. And so that's one thing that you could do. That way you're at least putting your money to work versus giving it to the IRS. The second thing, which we haven't talked about here, but something to look into, is something called opportunity zones. And so if you were to take, they're great for being able to reduce tax liability or defer taxes on capital gains. And so Google opportunity zones, and there's a bunch of information out there, but basically you're deferring and reducing the amount of capital gains you have to pay by investing in certain properties in certain parts of the country. So.
Yeah, if I may complement what Eric has said, is unfortunately you sold your property in 2021 without actually letting us know that this was a need. There's an instrument also called 1031 exchange. I don't know if you guys are familiar with that, but 1031 exchange is a kind of like exchange, and you could actually transfer all of those gains into a new property and pay zero taxes, right? So 1031 exchanges are very, very powerful. I'm not a CPA. I can't speak very highly on the level of detail of a 1031 exchange, but I utilize 1031 exchanges for my personal properties. What does that mean? If I sell a house that I purchased for $100,000, today I sell it for $500,000. I have $400,000 on proceeds of that sale. As long as I buy a property that is, if I am not mistaken, it's double the amount of the cost of the profit. Of the sales price that I made, I can actually apply 100% of that amount, but please verify with your CPA. Also, 1031 exchanges, the way it works is this. You have usually 45 days once you sell your property to identify the new property where you wanted to purchase. You can identify a lot of properties, many properties. You don't have to purchase every property you identify, but you do have 180 days from the sales date of your property to actually close on those properties. So you got to be very, very careful that you don't sell your house without having anything on the horizon, because then you wouldn't be able to comply. There's also 1031 exchange coordinators, which I highly recommend. That's all they do. They'll hold your money for you, for the 1031 exchange. So there's no complex, accounting you have to do. 1031 exchange coordinators are great. Oh my God, we have a lot of questions now, Eric. I love it. So if I sell a home for $1 million and do a 1031 exchange to buy a new property for only $800,000, how do I protect myself from taxes on that last $200,000? I don't have the answer for you. I wish I did. I don't think you can actually sell the property. I think they do have the tax liability on the $200,000. Are you aware of anything like that?
Yeah, they would have the tax liability. They have to recognize that as income. And so again, depending on what you exchange into, or you buy yourself an additional property and do cost segregation, create a deduction to offset that $200,000 of income that you have to recognize. But yeah, you would have to recognize that income.
But you got to remember, right? If you have an additional $200,000 of income, you can buy with 20% down or 25% down, you can buy over $1 million of properties, right?
Right,
So your
right.
cost segregation will actually be upon $1 million worth of value, not only on your $200,000 on down payment, because this is what people don't realize on real estate. You cannot come with 20% down of a stock value and purchase 100% of that stock value. So real estate with $200,000, you can buy $1 million worth of real estate. $1 million, 20%. If you're not maxed out of Fannie and Freddie loans, those are actually subsidized by the federal government to give you a better interest rate because you're investing into real estate. So make sure you talk to one of our team members to understand what the strategy is as far as investment. But you can really leverage that additional $200,000 into $1 million worth of properties, or maybe more. So, and your cost seg is going to be based upon the $1 million, not the $200,000. So the offset is going to be huge. Thank you so much. A lot of great questions. I know this is a very specific topic. I know we had some technical difficulties. Erik, once again, thank you very much, my friend. Always a pleasure. Thank you for being here, giving us the pleasure to answer a lot of your questions. Hopefully you guys have learned something that is going to save you money. Make sure you guys keep the majority of your money. It's not how much you make, it's how much you keep. So we appreciate you guys being here today. This is going to be available offline. Go out there, make some equity happen, guys. I really appreciate you being here. Erik, you're a superstar. Thank you, my friend. Take care.
No, thank you. Thank you, Wagner. I appreciate it. You have a great day.
You
Thanks
too.
for having
Take
me.
care.